Yeah, well, it's interesting because when I started my career, which was 30 years ago, we were really at the beginning stages of the authorities dealing with inflation, that experience through the 70s. And so the groundwork had been laid to deal with inflation. And even though it was still high, it was on its way down. And so, to be honest, my whole 30-year career, I've seen declining inflation rates, declining interest rates, which means that most people in the industry, probably 90% of people in the industry, have had the same experience. So really, in terms of how markets react to inflation or the prospect of higher inflation or the potential for a scare in inflation, it's really only from the textbooks for me and most of the industry. Now, having said that, we do think interest rates have bottomed. We do think inflation's bottomed. We think the inflation numbers that are released into the market are not reflective of the true underlying inflation. We suspect it's a little bit tighter than people realise. But I also believe it'll, just like it took 30 years to go from one extreme to the other, inflation's not going to return overnight. But the seeds are being sown. And so we've seen a trough. And so there'll probably be quite a few years of not being apparent that underlying tightness is starting to emerge, but it's emerging. So people have to think differently about their investment ideas, where there's likely to be opportunities to put your capital. It's going to be very different from the 30 years that we've seen. For example, property, prime beneficiary of the lower interest rates that have come from lower inflation. 30-year trend. Don't underestimate just how far we've come and to what an extreme we've come. So over the next 10 years plus, the reality is interest rates are probably going to be quite different to what we've become used to over the last 5 years. It's going to be interesting because the reality is none of us have that experience. If interest rates are bottom, the first thing people have to remember is that the discount rate's going to be going up, which depresses valuations across the board. So the reality is if you want to make an acceptable return, you've really got to come across companies that can grow their earnings. So that's really got to be your focus. On the opposite side of the equation, you want to be avoiding companies that are going to struggle with their earnings or who have been the prime beneficiaries of that lower discount rate. So property is a classic. If you can find something that's leveraged to property prices, and for example, a shopping centre REIT, because it gets a double whammy of not only property prices, but their industry is under siege because the amount of capacity that's gone in, thanks to Amazon and all the online retailers, means that even with property prices being flat, they've got serious issues. But it's like the double whammy. So we're trying to find short opportunities in anyone leveraged to property or deteriorating fundamentals. Infrastructure, it's a discount rate play. It's any classic defensive stocks that benefited from the fear of the post-GFC period that are struggling to grow their earnings. Food, for example, they haven't grown their earnings. I'm talking about the Campbell Soups, the Kellogg's, all these sort of things. Haven't grown their earnings in 5+ years. Now there could be a consolidation story there, so that might play out a little bit differently. But there's a number of industries that have really struggled and have purely gone up on the basis that they were seen as safe, and with the discount rate coming down, their dividend yield was okay, or their cash flow yield was okay. But if you can't grow your earnings going forward, you're going to be in trouble.